start, and it's been a strong, patch, so to speak. Samir Arora joins us. I always look forward to our engagement with Samir. We talk about markets, we talk about life, and these days Samir always talks about the magic. So a lot to focus with Samir in today's interaction. Samir, good morning. Thank you for joining us. We'll talk about your latest magic trick, but right now, I guess the markets have surprised us with the magical strength.
Yes, Nikunj, and first, sorry to hear about your dad. It's been a sad, tough phase for many people in the last few months. So talking about the market, yeah, it's been stronger than I would have thought, particularly in the month of May. Before that and after that, it's been okay. But I would have thought that it'll be more sedate with all the things that were happening and very clear evidence that some sectors will be more badly hit. The problem on coming on your channel is that you already know everything. I just heard your introduction. And what can anybody add to that? That this cannot be a repeat frame for what happened last year, because people have been hurt more badly economically, emotionally, psychologically, and therefore some things have to give. But for the moment, everything is hunky-dory as far as the markets are concerned.
Well, Samir, you're the man with wisdom and experience, and those are two things which always matter. So, Samir, how should one approach this kind of a market? The temptation to sell is high, but if you're selling, you're regretting. Whether it is liquidity or complacency, but the underlying factor is that buying and participating and not selling is making money. So, how does one deal with this kind of a market?
No, that is true, because my theory has been that if we look at the market at all the time, some 1/3 of the stocks are doing very well relative to the market. It is just the way the market is defined, which is an average of all the stocks. My point is only that it can't be that two contradictory things can happen simultaneously, which is that every commodity company says that the commodity price is the start of a new cycle because of, say, what is happening in China or whatever else is happening. And then every consumer durable company says that I will normally pass these on in a few weeks or in a few months. Or the same thing with the oil companies, that on one side ONGC is going up, on the other side the guys who consume energy as an input or oil related this thing are saying we will go up. So that is what I feel is the difference. The whole market going up means that it is not being driven as much by fundamentals, and we can't even say global liquidity right now. I think it is being driven by the retail investors who suddenly feel that they are in control, like it's happening in US. And I don't think, now you can call me old guy, whatever. I don't think that some of these things deserve to go up as they have, because people are only trading off the headline. They are not trading off what was known, what was discounted, what is the valuation, but just off the headline.
Samir, I like to bring our viewers who are young viewers, not spend so much of time. One thing I've admired about Samir is the ability to catch new trends. I mean, when he bought into private banks, when he started investing in IT, I remember he bought the stock of DRL because DRL was a pure R&D pharma company 15, 17 years ago. Samir, a lot of new companies will go public soon. Paytm, Lava, Zomato, Delivery. You like to buy high growth businesses. Is that a high growth space which you would be looking at as a public investor?
There's a big difference between what we did in the 90s and even like Bharti or Infosys or whatever. Every stock mostly we had at some early stage. But that is because we were ourselves acting like sort of private investors in the public markets, in the sense that these companies were going public very early in their life when the growth was ahead of them. So, for example, Z in 1998 had a market cap of some $50 million, and we bought 10% of the company, went up some 100 times, and so on and so forth. Today, the problem is that most of these companies are coming to the market 10 years after they've been around, and where a high part of the growth has been squeezed out because of private funding and whatever before they go public. So this will not be as straightforward as before. Because these companies are going to come at much higher than market valuations, and a large part of the early growth would have already been enjoyed by the private investor. So this will not be the same.
Okay.
You can't have it both ways.
Samir, while we've
private
been
company.
noticing the pickup.
Yeah.
Go ahead, Samir.
I was only saying that you can't, you means the private companies can't have it both ways, that they first go from 0 to 10 and 20 and $30 billion market cap while being private companies, then come to the public market guys and say, see, last time when the early companies got listed like Infosys, it went up 1,700 times and Z went up at that time 100 times and TCS went up so many times because those guys went public very early. So this will be normal companies, normal high growth companies. One or two we are firmly interested in, others we are firmly not interested in today without even meeting either of the companies, by just knowing what we know in terms of as just, investors in general.
Point taken, Samir. Tell me, in a way, can the same logic be applied to what's happening in the markets otherwise, with retail investors wanting to get in, but some of the more preferred names already, trending at those record highs or extremely strong valuations? While they may be fundamentally very strong companies, if we're, looking for consistent growth year on year, is it too difficult to get into some of these names for a retail investor at the moment? And if so, then, do they look for other opportunities or do they wait for corrections?
I think that in general, the markets have a ability to generally give 13-15% returns per annum, not specifically over any one period, but annualized over multiple years. And that has to do both with, the equity risk premium, as in if the debt guys are giving 5-6%, the historical premium would be 5-6%. So you can get 12-13%, or you can just look at the economic growth of the country in nominal terms. But what you are talking about is the steady 20% growth companies which are trading at 70, 80, 90 multiples. The question there is not so much of the multiple, but of the fact that there is no way of being confident that these companies can grow 20% per annum. Because I have one simple thumb rule which can be easily used by retail investors, I think, which is that in general, you have to believe that if the product or the service of that company is under-penetrated, then there is a small chance that that company can grow 20% per annum for 10, 15 years. If you look at HDFC Bank and Kotak Bank and all these guys, when they came in, you could say that they were under-penetrated because the state-owned guys had 100% market share. And so you can take their market share plus grow in general. And with that environment, they were able to grow 20% for such a long period. If you, when you have opened enough branches, or similarly in other things, when you've gone into smaller towns, you've gone into variants, you've started your small brand, your big brand, there's no chance in hell that any of these guys can grow 20% per annum for 20 years. That, according to me, will only be in areas which you can mentally say in some framework that it is under-penetrated. And there are a few that we think we have, but it's not these paint companies or selling chocolates that you can say is under-penetrated in any way.
Okay, that gives us some direction. Samir, do you feel we're gradually finding our own path, getting disconnected from what's happening on global markets, or do you feel that is that's a given, that we are going to continue to respond to any knee-jerk reactions there? I know you said that inflation should not be such an overwhelming concern, and it doesn't seem to be for the moment, but want to get your sense on really whether or not our markets are building their own bubble or still very much vulnerable to what happens globally.
To what happens to the mothership, which is the United States. There is no way that we can say that we can outperform or underperform, but the direction will be broadly the direction of the US market in some sense. And also FII flows have not been less in the last 1 year or even this year to say that, see, we are doing well without them. We are doing well along with their flows, maybe you can say. But there is no way to suddenly say that the foreign markets and the foreign influence has come down. In fact, the private equity money is all foreign. The venture cap money is all foreign. Actually, I have another bigger picture, philosophical negative. I am very positive. My net is very high. We have a long only fund. But I'm saying because I raise issues which I feel are something is going wrong doesn't mean it has to happen today. So the thing is that all the old, steady, ready infrastructure, completed buildings, completed airports, completed roads have been sold to foreign investors. All the younger generation of mid-cap companies have basically, not all, but many wanting to sell their stakes to private equity companies because they themselves want to become private equity managers and basically want my job of being a fund manager in an air-conditioned office rather than running their factories. And all the new startups are basically 95% invested by foreign investors, and the starting teams have 5, 10, 15% stake. So the three places where there was role of an Indian ownership, large Indian ownership, all of that is now owned or will be owned by foreign investors. Effectively, you're hollowing out the entrepreneur in that sense. Because you can say that the new startups and the 100 unicorns are basically Indian companies. But I don't think in any of them the owner, promoters, or the Indian employees, except in a few cases, have maybe even 20% stake. So in all the cases, you're not getting the local guys to set up or motivated to do that because of who knows, but basically relative benefit, not benefit actively given, but advantage to foreign capital. So foreign capital will be always a big part of India now, even more as we go along.
Indeed, it will. But the one space domestic which is holding out right now, Samir, is the entire PSU banking story. I recall our last conversation with you, and you said that you don't hold anything other than SBI from within the PSB space. Have you expanded that pool after SBI's earnings, got even more convinced about the story in SBI?
It's easier to buy more in SBI than to try and buy a new bank. So actually we did increase it, and now it's become our second largest holding from maybe being our fourth or fifth largest holding. Plus also because it has appreciated more than other banks. But I don't find the need to buy another bank, because the thing with this bank was not so much just that it's a PSU, but that it could compete with private. Its technology is as good. Its subsidiaries are very attractive, very big, listed, so you can track them. So it is not just that it's a PSU bank. It deserves to be at least like an ICICI rating in terms of valuations. But no, we are not easily. Even this itself, you can say we've been late. We came in whatever, maybe July, August last year. Next one will need much bigger mental reset.
Indeed, it will. Samir, the one question we get asked often is, how is it the one gets rich? So if one of our retail audiences were to come and ask you, how is it that I get rich in the next 1 year, what would you tell them?
You can't get rich. The market is not a lottery. It is not that you get rich if you are not rich in 1 year. The market has one or two distinct. One is that it is that you should have your own job, and with the savings that you have, it is better in a longer term sense to invest that savings in the market rather than putting it in a fixed deposit, particularly if you are young, because you can take that risk. But in 1 year, it will not change your life. It will make you more and more use the savings that you have more productively, so that over time they work for you in a bigger and bigger way. But there is no way of ever answering this question in a serious way. How can you become rich in the market? You could if you start even richer. Then there would be many ways to become rich by losing a lot of money. It's not that straightforward. But before that, let me go to this PSU story. So let's look at this home finance company, which was, people believed, owned by a PSU or PNB bank or whatever, and it was owned 40% by private equity already, and I think they had their own CEO. But now, because that stake has gone beyond 51, suddenly, as if the PSU owners were so bad, which there's no, I mean, I don't know exactly, but what was it that they were doing so bad, which will change so much? So the point is the discomfort or the suspicion with which we look at PSU ownership is so high that there is no point in just directly buying any of them.
So true. Samir, you rarely buy commodities because that's a sector which, in a sense, historically Samir Arora has always avoided in this current avatar, previous avatar. How do you resist the temptation of not buying a SAIL or a Tata Steel when the entire world is going through this wave of commodity surge?
I bought Tata Steel, and we are single-handedly responsible for stopping the global bull run of steel. Because since we have bought it up like 2% or something. But my idea generally has been that, if we have been given $100 and our job is solely to outperform the market, let us say that some sectors which I don't fully understand, but they are going up a lot, and there is some logic. It's not that there is absolutely no logic. There might be some logic. So if you buy 3%, 4%, 5% in that, and you sort of neutralize that effect, and then with the balance 95 try to do whatever your heart says, it's a fair thing. It is not necessary. That's why I totally reject anybody who comes and says that we have a formula or that we have preferred sectors, as if the market will first check with me that whether these sectors I like and then do well. We try to neutralize some of these things, and in that sense we try to neutralize Tata Steel. Of course, after that it has stopped working. And that has been my history for the last 25 years, that I can stop some of these bull runs if I were to just even buy 2% of my fund in those things. What is the point of me sweating every morning and evening whether I have understood this event or not? Because it does make some sense. It's just that it's very difficult to make a super long-term view on that. So just neutralize it and try and do well with the balance 95. And 25 years, I don't think anybody can match. So it's worked.
Great point. Now I've got some more time today, so I'm going to ask the magic part in the last. But my next question, Samir, is that, we had Sanjeev Bajaj on the channel on Monday, and he made a very interesting point. He said, look, in the financial space, NBFCs like ours are trying to become Fintech, and there are Fintech companies in the startup space who are becoming NBFCs. How would you view a stock like Bajaj Finance or HDFC Bank? HDFC Bank is a traditional bank but trying to become a platform now, and so is Bajaj Finance.
So I think that now, what to say, because I think that some of this for the NBFC trying to become a fintech is to think that a fintech is getting higher valuations. Otherwise, what is a fintech? Basically, you are trying to introduce the two sides on one platform. And were these NBFCs to say that previously they were not effectively making the lender, which at that time was the bank maybe, or the individual, lending to the borrower. And also the thing is, if the market cap of a company is 40 billion and you say that I'm a fintech and the stock goes up 4%, that for that base, or just for that, that means you already have a $2 billion fintech. So I think this change of labels for Bajaj Finance, I don't relate to, because it was already a very, very big company. It already was effectively doing the same job. It's like saying that Tata Housing, let us say, you remember that Tata Housing said that somebody has bought an apartment online. I remember this 2 years ago or something. Now, please tell me where was the third house that was ever bought online. It was because you had started a new scheme and somebody went to buy a house and they said, now you've seen it, you like it. Now, can you please log on to the laptop and book it through that? And therefore, it was announced that apartments are being bought online. And from that day to today, nobody's bought a third apartment online. For HDFC Bank, it is different. HDFC Bank anyway has to sort of appeal to the people who don't want to go to the branch, and the young people who feel that it is easier to do some of these things on app or online. And therefore, they have to technologically upgrade themselves and compete with the world, not to get a higher valuation, but to continue to be leaders in what they are doing. So for them, it's a necessity. For the other guys, it is just a label change for which there is no logic to be giving higher valuations for that part of the story, that now you're a fintech and not an NBFC. I don't see any difference.
Great point. Samir, individuals do matter. The minute it comes to HDFC Bank, we say it's Aditya Puri's, vision. When it comes to Reliance, we say it is Mr. Ambani's, vision. The Tata Group has seen a major comeback, both in terms of performance and also in terms of stock market re-rating. Whether it is a Tata Consumer, whether it is Indian Hotels, or whether it is Tata Motors. Do you see merit in this belief and the faith markets have in Chandra's ability to turn around some of the Tata companies? Because every Tata company, whether they're in the same business or not, doesn't matter. As long as the prefix is Tata, that stock is a 50%, 60%, even 100% in last 1 year.
So we also own three of them, TCS, Titan, and now a little bit of Tata Steel. But I think Chandra's thing has been that he brought some basic principles which were very much needed for these, which was, say, reduce debt, rationalize, consolidate. So you make Tata Consumer into one company or whatever. And so these 3-4 things which were needed or are needed in any company which may have higher leverage or a lack of focus or too many brands, too many businesses. So those simplest things were done one by one in many of these businesses. But in the end, the ones we are owning today are the ones which were always doing well, or don't know about Tata Steel, but I mean TCS and Titan. But in general, yes, because if somebody has that discipline that you will not, I won't give the name, although there is only one name. Now look at this one company which announced after many, many years that we will do capital rationalization and we will sell off unrelated businesses and we will don't do unrelated things. And then 3 days ago said, oh, sorry, we are going to just do a new round of investments in new areas and again have. So that kind of discipline is needed, which I think Chandra has brought very well to the Tata Group. And therefore, in that sense, even the companies themselves, individual operating companies, must now be knowing, even if nobody's telling them every day, that stick to the knitting, stick to your area of expertise, don't randomly go into areas which were either nobody's areas or areas of other countries and so on and so forth. But that doesn't mean that every Tata company has to go up, and at least we have not looked at it like that. In none of our meetings, our research meetings, or with any of these guys, the Insure and all, we say, oh, let's find another Tata company to buy. But if it comes, we will buy. But so your question is a bit different. I don't think fund managers are looking at it like that are we underweight or overweight the Tata Group or something like that. But it just means that each company, because when you look at it, looks more focused, more, less debt and unrelated diversion downward, whatever. So it appeals to the people who are looking at them.
Fair point. So Samir, I know of late you become a Harry Houdini fan. You started with card tricks, then a rope trick. Which is the next one? Do you want to demonstrate something live? Maybe like a disappearing act by Samir Arora on a live television interview?
That I can do. But I can do disappearing act by switching off my camera. But the thing is, this is the difference between the first phase and the second phase. In the first phase of lockdown, people were, I was spending 1 hour on Saturday, Sunday on YouTube trying to see magic tricks and all. Now you don't feel like doing that, although in a sense, we are still in a semi-lockdown state. So that is the change in psyche now, enough of, staying home and doing all these things. But when I travel, I always, if in these touristy places, you have all these magic trick shops, so I always go and buy something from them. And when I get to travel, I'll buy and then I'll show you.
Well, I look forward to that one. Maybe we'll call the next one as the disappearing act by Samir Arora when we meet.
Okay, thank you very much. Stay safe, guys.